Welcome back to the GovCon Funding Podcast. And folks, let me ask you, you may need credit for your business if you're a government contractor for a number of reasons. Maybe you want a new contract and you need to hire folks and you need to cover that payroll. And maybe you need to buy equipment for that new contract. All of that needs working capital. And oftentimes your business may not have the working capital that you need to cover that. So that's when you turn to outside sources of capital. And in episode 1, we talked about the different types of capital that government contractors can use to fund their business. Today, we're going to go deeper. We're going to talk about each one of those sources of capital and how fast can you get access to that capital? And then what type of cost will you have to pay for that capital? Well, before we get into all of that, let's go through our disclaimer. This podcast is for educational purposes only and does not constitute financial advice for your specific business or personal endeavors. Gilman Bagley and the people appearing on this show are not liable for your results from the content we present in this episode. If you want specific recommendations, contact us directly. See our contact information in the show notes or go to gilmanbagley.com. And hey, while you're there, you'll probably notice that we provide fast and flexible financing solutions to small businesses and lower middle market companies that allow them to access working capital by leveraging their business assets. And we've funded up to $500 million or more to our customers in total, and fast approvals and same-day funding. And we did all of that with 100 plus years of private credit and business growth expertise. And a side note, we don't just provide government contractors funding, we provide a lot of commercial companies across many verticals funding for their businesses to grow. So I'm going to welcome our co-founder, Matt Gilman, back to the show. Matt, welcome. Matt, let's start with this first level, which is friends and family. This is typically the type of capital that startups are trying to pursue. So let's talk about this first category of friends and family capital, Matt, and let's first talk about how quickly you can get access to that type of capital.
Sure. Yeah, look, friends and family is obviously going to be in some cases, obviously a less institutional and a more simple track to getting capital. And that's where you're going to have a very wide range of cost. You could have some very nice friends and family who give you kind of below market rates, right? Prime is at 675. They probably don't know what prime is, right? They look at it and they say, I'm earning 4.5% in treasuries and maybe I'm cool with, a 7% interest rate. And you can get that from friends and family. But then we all have friends and family that might be a little bit more aggressive, that comes out there and says, hey, I think I'm taking extra risk here. I'd love to get 15%. So, I think the biggest benefit of friends and family is, you're really operating oftentimes in a lot more of a handshake, even though you have documents, but your cost of funds can vary.
Yeah, that cost of funds. And you mentioned the current bank lending prime rate at 6.75%. And we talk a lot about, and we will talk a lot about in the show about cost of capital. And that's basically how much are you paying to get access to that money? That's interest. It could be other sources of costs that could be opportunity costs as well. And we'll talk about those in a second with the next category of funding. But I also like to touch on what you just mentioned, Matt. You can get access sometimes to friends and family capital pretty quickly. And depending on how they are as individuals, they could vary in how much they want to charge you in interest. If they charge you interest, some may want to have a piece of your business. They may want equity, and that's an opportunity cost that you are giving up early in the growth of your business. So be very careful when you start considering equity. And some may be sophisticated and ask for both equity and provide you some sort of capital in the form of a loan with an interest rate as well. So there are a lot of ways that you can approach the friends and family. And let's also mention, as we did in episode 1, that part of this category is your own money. Maybe you take money from your 401k program. Maybe you take money from savings. Maybe you cash out of some stocks and you use that. There's an opportunity cost associated with that time cost of money, that when you're taking that money and putting it into your business, you're taking it out of the marketplace where it's growing. And over time, you're going to find that you left probably a pretty big gap in what you could have earned over the long term. So all very important considerations in the friends and family category. Let's move on to the next category, Matt, and that's venture capital. And this area, I think, is the one where we talk about opportunity cost the most, right?
Yeah, definitely. But I think if we first kind of look at a little bit of like a holistic approach, right, and say, you know, in our first episode, we talked a little bit about what are you doing with the money, right? Because friends and family money might be great because you're at the stage at which you don't have contracts and you don't have revenue, and you're looking at friends and family and you're saying, okay, this is actually maybe cheaper than raising equity, right? They're going to let me pay an interest rate for the money for me to build my business from a point at which I have no revenue. And that could be looked at as a very cheap option. But as companies start to build revenue, you know, and we'll go into some of those other products, there's no reason to use friends or family, right? There's no reason to give up equity. And I think that's where the topic changes a little bit more around just, is it the rates, or is it the product structure, or where is it coming from? Because when you look at venture capital, you know, I'd put that in sometimes the same bucket. It's very early stage money. It's going to cost you a fair amount of equity. Now, it could make your value 5 or 10 or 20 or 30 times greater in the future by having that equity, but it's still going to cost you equity. So the question is, are you at the stage in your company where you need to give up equity to accomplish your goals, or are you able to use debt?
Yeah, that's a great point, Matt, is always looking at what your purpose is, what your objectives are, what your growth strategy. And that's where you really need sound advice specific to your personal situation, hence the disclaimer at the beginning of the podcast. Always seek specific advice from experts. And, you know, I also want to touch on what we like to say in the industry: there's smart money and then there's stupid money. And it's also important to consider, when you're looking at these different sources of capital, kind of the quality of the capital that you're getting. And what I mean by that is, what kind of advisory support are you getting along with that source of capital? So friends and family, you might have an uncle or a spouse or somebody in your family that was really a big success as an entrepreneur. They really understand entrepreneurship, how to succeed. Maybe they understand your industry really well. Well, you know, they may provide advice along with their capital and make sure that their investment or their payback has a higher probability of return for them, and give you some good advice. Same thing with venture capital. You may get advisory support with experts in that venture capital organization that may help guide your corporation. And so that's another factor to consider as well, is kind of this cost, speed, and quality. But oftentimes you can only pick two out of that combo, that triangle, if you will. Okay, so let's move on to the next category of credit cards. And a lot of folks, you're listening to this, you think, okay, I know what credit cards are. I've had credit cards for a long time. Let's talk about this just briefly, Matt, and let's just kind of emphasize the cost of credit cards. I think everybody knows you can get credit cards pretty quickly if you have pretty good credit scores. But let's talk about what the cost is right now. I looked it up today. It looks like the average credit card rate is coming in at about 21% APR. Anything you'd like to add on the cost of credit cards?
Yeah, and we've touched on this one, right? Credit cards are great if you're using them to solve timing, right? If you're using a credit card to bridge a gap, which is a short-term gap, 15, 30 days, or you're using credit cards to maybe get points or get cash back, but your intent is not to carry a balance. And I think people sometimes get caught carrying a balance on credit cards at a 21% interest rate, right? And that's where I think things get very, very costly. Biggest benefit of credit cards: if you use it and you use it in the window you're supposed to use it and you pay it back in full, it doesn't cost you anything to buy roughly 30 days or 40 days of leverage as long as you pay it off in full.
Yeah, that's a great point, Matt. When you look at the chart here, you have a lot of these different sources of capital. You can mix and match. You can use credit cards, you can use venture capital, you can use other traditional lending. And actually, talking about traditional lending, let's move on to the next category of bank loans. Now, this one I think we should spend some time on, because there's an element of time, and then there's an element of cost that we should talk about. So let's talk about how long it typically takes for a bank loan to process. Now, depending on where you are in your growth phase and the type of financials that you have, you can expect your bank to ask for a lot of those financial artifacts. That could be your financial statements. It could be your personal financial statements. It can be other artifacts that they may want to receive from you so that they can conduct their credit analysis, their underwriting process, which I can tell you from experience can take some time, sometimes as much as 4 to 6 weeks to go through that process. But there is an element of cost here, and I think we should probably talk through that a little bit. Matt, anything you want to add on the time element here when it comes to traditional loans from a bank?
Yeah, I think if we talk about timing and we talk about where you are in the process of or the life cycle of your business, I think it drives what products and talking about banks specifically, you might be eligible for, or what might serve you properly. The bank process in some cases is a 90-day process, right? And I think that's a fairly good average, and I think that's somewhat similar for the SBA process, depending on how complex the situation is. But I think all bank products are not equal, because a signature line, right, where maybe you have really good credit, you're signing on a business line, but really the bank is relying on the fact that you have a really strong personal credit profile. You could be in a scenario where you have fairly low cost of funds, mid to high single digits. Your timing for that line could be 60 to 90 days still, but you're going to be in a good scenario, but you're going to be capped, right? So I think you really have to sit there and say, is this product right for me today? And is it going to be right for me in 6, 9, or 12 months? Because like most secured lenders, right, bank or non-bank, they're going to file a UCC on the business. So it might be great to see a $75,000 line from a bank at a 7% interest rate, but you have to remember they are going to file a UCC on your business, which means you're not giving up, but you're now allowing the bank to file, right, a secured interest in your collateral, which if you're a government contractor or you're a B2B company and you're growing, you're going to have this asset like an accounts receivable that keeps growing with you. You might have $400,000, $500,000 at some point of accounts receivable, and the bank has an all asset lien, which includes it, which means you're going to have a hard time going and getting additional financing without taking out the bank. So I think, the bank product is going to be, lower cost. Is it going to be able to grow with you? If you grow quickly, historical financials don't support the future. So your cost of funds is going to be great. If your company is going to stay the same size, great product. If you're going to grow, you need something that's going to grow with you.
Yeah, Matt, can you also touch on the first time we've used this in the podcast, the UCC filing? Can you tell folks what that means if they haven't heard of that term before?
Sure. When you go out and you get a business loan, right, and you sign a loan and security agreement, or a factoring agreement, whatever it might be, you're going to end up, pledging collateral, right? So that's going to be inventory, it's going to be accounts receivable, it's going to be equipment, whatever it might be, right? And there's going to be a standard filing by a bank on your company's assets, which means you can't pledge that to somebody else. Right? It's the first position is going to be your senior lender. So the UCC filing is standard. It's across the entire industry, bank or non-bank, but it's going to cover all of your business assets. No, in a very simple comparison, when you go and you purchase a home and you have a bank that provides you with a mortgage, that bank is going to have a senior lien on your home, and that's the same concept.
Okay, great. And at today's publishing of the recording of this podcast, the prime rate, according to the Federal Reserve, this is the average bank rate, prime rate for business loans, is at 6.75%. Can you real quickly just explain to folks that you're going to pay most likely from your bank something more than 6.75%. Can you explain that a little bit?
Yeah, the Wall Street prime rate is going to be the benchmark, right? So, for example, SBA loans are going to use a benchmark of prime, which is at 6.75% today. Most SBA loans are not fixed, they are variable. So they'll go up or down if prime moves. So at 6.75%, you might read that and say, that's where my rate's going to be. And like you said, that's not the case. They'll use it as a benchmark and they'll put a spread on it. So depending on the size and the program of an SBA loan, for example, you could average anywhere from prime plus 1.5%, right, which would get you at 8.25%, right? Or it could be prime plus 6.5%, depending on the size, and that'll get you at like 13.25%. So don't look at prime and say, this is what I'm going to get to borrow at. Look at prime and say, okay, that's going to be the benchmark. If prime moves up a quarter point, my rate on my SBA loan is likely to move up a quarter point. But what we see on average is typically larger SBA loans are about prime plus 250 or prime plus 275. And then smaller SBA loans start to get into the prime plus 300, prime plus 400, and you start to get into the low double digits.
Yeah, that's great how you mentioned the sliding scale. As you're a smaller business or an earlier stage business, the bank interprets that as a higher risk, so they can take that into account when they're creating that quote unquote spread, which is the prime plus whatever the bank wants to charge in addition to that, because they're pricing in their risk when they look at you as a business entity. And so that's always important to remember that fact in that kind of concept. And we'll go into these concepts in more detail in follow-on episodes, but we're just covering the wave tops right now. So let's move on to the next category here. Let's just spend a few minutes on this one because we're going to spend a lot of time in this podcast and future episodes talking about private credit. But if you can just kind of draw the distinction and the difference on speed and cost versus bank loans when it comes to private credit, Matt.
Yeah, and again, private credit is a wide, like there's a lot of products and a lot of companies. There's companies that are in private credit that do $25,000 loans, and there's companies in private credit that do $500 million loans. So it's very, very broad. But if we focus on the small to middle market, right, which is the world in which we live, private credit can move a lot faster. I think what you end up with in private credit is you have business owners, right? You have entrepreneurs that are trying to build a product and a process that can operate faster than what traditional banks can do. They also are building products that they might niche down. For example, we focus a lot on government contractors. We're very good at understanding the companies, their ability to perform, the contracts, the financials we understand, and we understand how fast those companies can grow, right? So we spend the time to create and customize products that can fit for the industries that we're really good at. And the flip side, there are companies out there that might be really good in the energy sector or really good in the apparel sector. And they're really good at those things. So they understand what the procurement process is, how goods are ordered, how they're shipped, how they're delivered, when they get checked in, how they get paid, all of these different things. So private credit really exists to solve for companies that maybe aren't bankable, right? Or don't want to be within a bank. And not being bankable, oftentimes people kind of combine that with negativity. But that's not the case, right? You have companies that aren't bankable for negative reasons, right? And that could be they're losing money, their books are not in order, they're not overly organized, they may not pay taxes on time. Those are negative issues. But if you go to a lot of positive issues, you have fast-growing companies where the history and the historical financials might not support the future. You have companies that are growing moderately, but they decide to reinvest every dollar and manage a break-even business, right? There's intentional things that people can do to grow a company, but a bank will look at that oftentimes and say, well, I understand you're doing that, but it doesn't meet our internal ratios to get you approved. So in the private credit world, right, like we exist to be able to solve like a liquidity challenge or working capital for those companies.
Yeah, that's great. That's great. And so, folks, what we talked about today as a summary here is the different categories of capital. We talked about the different stages that that type of capital can be used. So in that early startup stage, we talked about friends and family, which can be fast, and those rates can vary depending on how much your uncle really likes you and and other factors that they may take into consideration. But it's certainly it's one of those areas that has a lot of variables, and always consult an expert before you engage with any of these capital strategies. The next one is venture capital. We'll talk about that in the same breath as private equity. You know, the venture capital is going to take care of those early stages of growth, the startup, the small business stage. If you're focusing on building intellectual property, growing quickly, your company can turn into $1 billion business someday. That may be well suited for venture capital, where you're going to forego some equity position, and it's probably going to take some time to engage those VC firms and get the capital from them. And a lot of the same lines for private equity. It kind of operates in a lot of the same ways as the venture capital would, but they're for later stage companies, those that are in growth mode and in the middle market range, where they may take an equity stake, they may buy out your entire corporation. And then we move on to credit cards. Everybody knows that those tend to be pretty expensive, but you can get them quickly. And if you do it right, you may not even have to pay any cost of capital. If you pay off the balance at the end of each month, then you avoid paying any kind of interest. The next area is bank loans, and those can move slower, but my personal experience, about 4 to 6 weeks on the processing for those. Maybe they can move faster, depends on your individual bank. And the cost is probably moderate when you're starting off. We talked about the prime rate at 6.75 today, and when is the day that we recorded this podcast. Make sure you check your own numbers on the day that you want to explore all these on your own. And when you look at the cost of that capital, it's going to change. It's going to change on the stage of your business. It's going to change on the type of financials that you have and the fundamentals that you have with your business. So those will vary above the prime, as Matt explained. And then finally, the private credit. You can generally get that faster than other sources of capital, but you will pay a moderate cost for that. And it's going to be a little bit more than what you would pay for a traditional bank loan, but it's generally going to be less than what you pay for a credit card APR rate. And so all of these factors are critical to consider. And whenever you pursue these types of capital, make sure that you always consult an expert. And that's why at Gilman Bagley, we have over 100 plus years in private credit and government contracting expertise, because we are vertically aligned. We understand the government contractor world. We understand that you need to often move quickly. You've won a contract. You need to execute on that contract. You need to meet payroll. We're there for you to move quickly and support you, whether it's the labor cost of capital, or the labor working capital or equipment. Reach out to us. We have that expertise and that knowledge in the government contracting space. We're here to help you out. Check us out at gilmanbagley.com, and we'll see you in the next podcast.